My name is Jonathan Freed, and I am with the Media Relations Department here at the New York Fed. Just a friendly reminder, but we ask you to please respect that this is not a forum for questions about monetary policy. We will be very happy to take your other questions, though. And we've been asked by our intrepid sound guys if you can please grab a mic when you ask your question for the benefit of, particularly the benefit of those following on the webcast. Okay, so let's open it up. Caroline.
Hi, Caroline Gage from Bloomberg. I was hoping you could elaborate on your forecast for growth for next year and 2015, and also what you expect to see in terms of those strengthening labor market conditions and on the inflation front. Thank you.
Okay. I'm not going to give you point estimates. You know, they say as a good economist specify a level over time or a time period, but never both together. You know, I think that our growth forecasting record at the Fed hasn't been very good over the last few years. We've been anticipating a pickup in growth, and that pickup in growth hasn't actually been realized. And we are anticipating a pickup in growth next year. I would anticipate something in 2014 in sort of the 2.5–3% type of range, and then a little bit stronger than that in 2015. That'd be my baseline forecast. But there's a lot of uncertainty around that forecast. In terms of inflation, we've seen a drop especially in core inflation over the last year, and headline inflation as oil prices have come off more recently. So we're about, measured by the core PC deflator, depending whether you look at the core or total, we're about 0.75% to 1% below the Fed's 2% inflation objective. What we think will happen is we'll gradually drift back up towards 2%. I don't think we'll get there. I don't think we'll get there in 2014. But the fact that inflation expectations are well anchored, that inflation expectations still have not dipped, should exert sort of a gravitational pull on inflation. So we'll probably head gently higher. Do not think inflation will be a problem for several years at a minimum. There is quite a bit of excess slack in the economy. The unemployment rate today is 7.3%. Capacity utilization rates are also relatively low. So we think we have plenty of room to grow. If I were to wish for something next year, I would be wishing for growth stronger than my forecast rather than weaker than my forecast. The labor market, I think we'll see continued, gradual improvement is the most likely if the growth forecast materializes. The problem that we've had over the last few years is that the payroll growth has been, okay, not as strong as we'd like, but it's been really relatively strong relative to the underlying growth rate of the economy. What's happened this year, for example, is you've seen okay payroll employment growth, but it hasn't really been supported by GDP growth. Productivity growth has been very, very weak, and so, one of the questions I think for 2014 is really what's going to happen to productivity growth, because that will really determine how much the real GDP growth translates to in terms of actual gains in payroll employment.
Okay. Anybody else? John?
Hi, Jonathan Spice with Reuters. You said, Bill, in your remarks, you're getting increasingly optimistic about the economy, maybe a follow-on, maybe a little more shorter or midterm. What would you want to see in the November and December jobs reports to increase that optimism? Thank you.
I think what I want to see is a pickup in the overall growth momentum of the economy. So it's not just about the payroll employment number that prints. It's really about will that be sustained in the future? I mean, I gave a speech a while back where I talked about the whole issue of Fed tapering. I said there were really two aspects of it. One is improvement in the labor market, but two is confidence that improvement in the labor market will continue in the future. And so I think the missing ingredient that we've really had up to now is we haven't actually seen an acceleration in the growth rate that gives you confidence that will actually sustain the improvement in the labor market. And so you really need to see the acceleration, I think, in economic growth to be confident that we're actually going to see substantial improvement in the labor market outlook in 2014. I think we're getting pretty close to monetary policy.
Anybody else? Hang on a sec, Carol. Okay.
Farron Powell with TheStreet.com. What are your, this is a question for Bill. What are some of your predictions for the 2014 housing market? It's been sluggish for the last 2 months. Do you expect it to be a sluggish 2014 year?
Well, I think that this is one thing that we're continuing to assess. How much has the housing market been affected by the rise in mortgage rates that we've seen since last spring? And I think that the data is still sort of coming in. I think that generally we would expect the housing market will do better, though, because if you look at the rate of housing starts today, it looks to be still well below what you would think would be supported in the long run by the growth rate of the population and the rate of household formation. We think that sustainable housing starts are probably 1.4, 1.5 million units per year. We're running at around 800, 900,000 units annual rate. So it seems to me that there's plenty of room for housing starts to increase. I think the hard part to evaluate is really how big a setback and how long a setback will you have because of the increase in mortgage rates. And the data today I think is sort of mixed. There has been definitely a slowing. It's a little hard to assess how long this will actually last. If you look at the housing price data, it looks like that housing prices are continuing to increase. So if you think about home building, that increase in home prices, I think, is probably, as I said in my remarks, is an indication that there's probably a shortage of housing actually available for sale. And so I would expect that will provide quite a bit of support to housing activity in 2014.
I have a question online from Hugh Morley at The Record. Some areas have recovered less than 75% of the jobs lost in the recession. A big chunk of that area is in northern New Jersey. What accounts for that lack of recovery?
Sure, I'll take a stab at this first. This is Jaison Abel. So, the two parts that go into how much recovery has happened in terms of jobs is first, how deep was the actual initial hit from the recession, and then secondly, what kind of job growth has occurred since then. So if you look at northern New Jersey in terms of our region, that was the part of the region that got hit the hardest in terms of the housing bust, in terms of the recession, and so there was a fairly deep downturn to recover from. And also New Jersey in general, and obviously northern New Jersey, also for quite a while had a fairly sluggish labor market. It's only been very recently that we've seen some pickup there. So when you couple the more direct hit, the larger impact from the recession with slower job growth, that's really what's accounting for the fact that it's been a weaker jobs recovery in northern New Jersey.
And Hugh, if you didn't catch it online, that was Jaison Abel answering your question. Anybody else? Caroline.
I was curious, President Dudley, if you could speak to this initiative you obviously have in terms of examining student loans, and I've been struck and not covering this market from our education reporters, just how valuable the data you have produced is, because apparently there's basically none. And I was curious, A, what prompted it, and how you're thinking about what's obviously a problem in terms of your long-term view of risks to the economy or the financial system.
Well, I think our job is to really understand what's happening in the financial system more broadly. And one thing that you see in the aggregate debt data is a very rapid rise in student loan debt over the last few years. And this is something that's potentially has real implications for economic performance going forward, especially the fact that people can't discharge this student loan debt, through bankruptcy. So this is something that sticks with them, and it's very difficult to get out of. And so it can actually have some pretty significant consequences to the economic outlook in principle, right? People can have trouble, with the student loan debt burden, unable to buy cars, unable to buy homes, and so it can really delay, the sort of the cycle in terms of how people actually acquire consumer durables and housing through their life cycle. Second, there's also a potential fiscal impact of the student loan issue, because obviously to the extent that student loan burdens become very, very high, then there's going to ultimately be presumably losses on the student loan that has a fiscal consequence. So this is something that we just felt that was a big enough market that's grown a lot, that wasn't very well understood, that it made a lot more sense to get more information. And we don't have a political view on what should be done about this, but we feel that we can be sort of objective stewards of the data, present things in an objective way, and that can actually help inform the debate about, is this a problem? If it is a problem, how best to address it going forward.
Raji,
So
anything
if I
you want to
may-
add?
If I may
please.
add something, so you had a question about the data. So we are actually very confident about the data because this comes from the U.S. Department of Education. So our student loan, all the data that I presented here today comes directly from the U.S. Department of Education, and the data actually allows us to distinguish between the different types of colleges. So I can actually distinguish for profits from nonprofits, from publics, from the type of them, the type of student loan, the grants that I showed you today, the enrollment, et cetera. So it's a pretty big data set, and we're pretty confident.
I wasn't
about it.
questioning your data. It was more just sort of the general understanding of this market in general. I was actually remarking on how valuable we at Bloomberg have found the research you've done because there's virtually no information on.
We're very happy to be helpful.
No, but I mean, it just seems like
No, I
for
think-
something that's a huge risk,
I think it's
potentially there seems
important-
to be no understanding of it
I think it's
whatsoever.
important to shine a flashlight on these kind of issues. And, I think we view one of our roles as the Federal Reserve Bank of New York is when we have access to data and when we have, we have really good, able and people here to analyze that data, we can be really helpful and, so to help encourage a good debate about these kind of issues.
Note to self, send Bloomberg bill for excessive use of data. Okay, thank you. John?
Back to your growth forecast for next year in 2015. I mean, you mentioned that I think the focus will be productivity, and I just wonder if you can elaborate on that because there are some obvious trends in labor market growth, but productivity is the wild card. And as you say, you've been wrong. The Federal Reserve has been wrong over and over again. Where will it come from?
I don't think I want to emphasize that part. We've been wrong in terms of anticipating a pickup in growth and that pickup not materialized. But I think there's good reasons for that. I mean, the degree of fiscal restraint this year was, really enormous and probably, considerably more than what we would have contemplated as likely to happen in 2013, a few years ago. I don't think we're so much focused on productivity growth in terms of forecasting because as I think you mentioned in your question, productivity growth is very, very difficult to forecast. I think the thing I was trying to underscore is productivity growth is a wild card. If you got low productivity growth next year, growth rate of 2.5–3% would actually lead to substantial payroll employment gains. If you got very high productivity growth next year, 2.5–3% growth would generate relatively low payroll employment gains. So the degree of improvement in the labor market is going to be driven in part not just by the real GDP growth rate, but how much of that is hours versus productivity. And that's just a wild card because productivity growth has been very difficult to predict through this cycle. We had very strong productivity growth during the early stage, during the recession and the early stages of recovery, very unusual. And more recently, we've had very weak productivity growth. So there's a pretty broad range of uncertainty about what kind of productivity draw we're going to get in 2014.
Cynthia, did I see your hand up before? Okay. Chris?
I just want to go back to the for-profit presentation a little bit. And this might have been beyond your analysis at this point, but I'm just curious, in terms of the overall student debt picture, are you guys looking at sort of in the future sort of factoring out how for-profits and how their students have sort of factored into both default and sort of the rising debt loads? And then also I'm just curious in terms of the higher tuition, if there's any sense of how federal aid plays into that, because I think a lot of students there take out maximum federal grants and loans, and I kind of wonder how that might contribute to higher tuition compared to public schools that have these subsidies.
So in terms of your first question, so we have two different sets of data here at the New York Fed. So one data, which is we have presented that data before on student loans, that actually we can see the total amount of student loans. Right now it's more than $1 trillion actually, and we are tracking them. So we are getting data refreshments and we are tracking them. We are going to track them in the future as well. And this is a different data set that you saw the findings today that's based on DOE data that actually allows us, that's not as grainy. The other data that we presented earlier is student level, this is institution level, but it does allow us to distinguish between the different types of institutions. So it's for-profits or what type of for-profits. And we have been analyzing them and we will continue to analyze them. So that will enable us to look at loans, how loans are actually for profits as well as other institutional groups, how they're actually evolving over time, that data do not have delinquencies. So these are two different data sets. Which is why I did not present anything relating to delinquency today. Whereas you can definitely see loans, you can see Pell Grants, other types of grants as well, which we'll look more into. So I think that was your first question. The second question is if there is a relationship between Pell Grants and tuition. Is that right? Or can you repeat your question?
Overall, the reliance on, I mean, you sort of have a lot of students at for-profit schools relying sort of entirely on federal
Yes.
aid, and that's where a lot of their revenue comes from. So I just
Yes.
wonder if there's any research that you've done or seen out there, or if you're looking at how that may tie into sort of the higher tuition levels.
Right, right. So the revenue composition of these two types of schools are very different, as you pointed out. So for the for-profits, actually, the main chunk comes from the Pell Grants, which are federal need-based grants that the students get. And on the other hand, they don't get government appropriations like state money, right? So on the other hand, if you look at the public institutions, their main chunk of funding comes from government appropriations and less from Pell. So as a result of that, the tuition for the for-profits, because tuition is the main chunk of revenue for the for-profits, it tends to be much higher, as you saw, and relating to the relationship between grants and tuition, there is no kind of causal research as of now. Actually, right now, we at the New York Fed are actually analyzing exactly that relationship. So I guess if you ask me that question, like a few months from now, we'll know the answer to that. But we are really analyzing that question because it's an important issue, and we are looking into it using the data that you saw today.
Anybody else? Go ahead.
Hi, Karen Maracek with Market News. I have a question about your housing forecast and how concerned you are about rising mortgage rates on your outlook over the next year, 6 months and year kind of time frame.
Well, it depends on why mortgage rates are rising. I mean, if mortgage rates are rising because the economy is very robust, then that would probably not be very disturbing to us. If mortgage rates are rising because market participants have a unrealistic view about, the timing of so-called liftoff, that would be very concerning to us. So I think it's very important for us to analyze why are mortgage rates where they are? Are they consistent with what the Federal Reserve anticipates how we're actually going to behave going forward? If they're consistent with how we expect to behave going forward, then I don't think there's any problem. If they're wildly high or wildly low, then it's important for us to communicate more clearly to get not just mortgage rates but long-term interest rates generally in line with what we think is reasonable. Monetary policy works through financial conditions. So we set monetary policy that affects financial conditions. Financial conditions affect economic growth. So we want, when we do something, we want financial conditions to respond appropriately. If financial conditions respond sort of inappropriately, then that's going to make our ability to generate the economic outcomes we want more difficult.
We have another question from the web, from my adopted state of New Jersey again. Can you elaborate more on what are the implications of New Jersey's higher foreclosure rate for growth and jobs going forward?
Well, I think, it's important to keep in mind in thinking about the foreclosure rate that probably the direct effect is going to be on the housing market itself. But of course, there are connections between the housing market and then the labor market. So first, in terms of thinking about the higher foreclosure rate and what that might mean for the housing market, there is a relationship between the stock of foreclosures that exists in an area and the potential for home price appreciation. In particular, places that have higher stocks of foreclosures have a less rapid home price appreciation for a number of reasons. One is that when homes go into foreclosure, the owners of those homes have less of an incentive to actually do what you need to do in order to maintain and improve that home. So they depreciate more rapidly. In addition, though, it's not just the home itself that's in foreclosure. There are externality effects to the homes that are around that. And as the neighborhoods where these foreclosed homes are start to depreciate, that puts additional downward pressure on homes. So the direct effect is that at least one potential concern would be that the market itself, the housing market, wouldn't wouldn't improve as fast as it could, right? And then, once you've established that, to the extent there's feedback between a robust labor market and housing market, that would just put the brakes on in terms of the connections between housing and labor market, in terms of, people who usually buy new homes, go out and replace appliances, make additional improvements to their home. That kind of activity just wouldn't be happening, and so some of the sectors that support that wouldn't be quite as active.
Okay, and again, for those of you online, that was Jaison Abel answering that question. Anybody else? Cynthia.
Hi, Cynthia from Dow Jones. Can you talk a little bit more about, talk about communication and building market expectations? I spend most of my time talking to investors in the bond market, and obviously what happened in September was quite unexpected. So and Bernanke obviously last night spent a lot of time talking about transparency and how that is used as a policy tool. So can you talk about communication and how you can prevent something so dramatic, like a sell-off in the treasuries market so dramatic in the summer that we saw again?
Well, first of all, I completely agree with Chairman Bernanke. I think it's pretty obvious that communication is always important for the transmission of monetary policy to the real economy, because, as I said earlier, monetary policy works for financial conditions, so it's important that people get our message broadly right. I think the difficulty is, there's a number of difficulties. One, right now, monetary policy is more complicated than normal because we have a number of different tools that we're using. We're using first short-term rates near zero, second, forward guidance, and third, asset purchases. So there's more moving parts. So that makes the challenge of communication a little bit more difficult than usual. And second, when we present a forecast, the forecast is the modal outlook. It's not the actual outlook may deviate quite a bit from that. That's why it's very important when we produce the summary of economic projections that we do every other meeting to recognize that that's the forecast, but that doesn't mean that forecast will actually be realized in practice. There's a lot of uncertainty around that forecast, and so what we actually do is going to be defined by how the economy actually evolves, not defined just by our forecast. So that's one thing that we've been trying to stress recently is what we do going forward really depends on the data. As the data unfolds, that's going to tell us whether our forecast is on track or whether we're off in terms of our forecast. So it's very important to recognize that, we're not omniscient. We don't get the forecast perfectly right, and so we're going to have to react and refine our monetary policy and our monetary policy message based on how the incoming economic information and market developments inform our judgment.
I have a second to that. You guys have said that you're not tied to market moves, but have you done any sort of analysis on how swift of a rise in rates would be damaging enough to the economy that makes you uncomfortable?
Well, I think it's very hard to generalize about how high a move in market rates would be damaging to the economy, because it really depends on what's driving that rise in rates. If the rise in rates is being driven by the fact that the economy is much stronger than expected, then it's probably not going to be of a great concern to us. I think I would be most concerned by a large rise in rates if that rise in rates were occurring in a way that was inconsistent with what I thought was likely to actually happen in terms of the trajectory of short-term rates, in terms of our decisions, in terms of large-scale asset purchases, in terms of the timing of liftoff, things of that sort. So if the market, has a view that very much differs with what I think is the most likely scenario, then that's a problem, because that's basically going to muddle the transmission of monetary policy through financial conditions to the real economy.
Anybody else? Angela.
Angela Hennersdorf, Business Week Germany. President Dudley, I have a question. You've been very outspoken recently about the bank's behavior. Was that a call for stricter rules and more regulation? Or what was your intention to criticize the Wall Street banks especially?
Well, I think that, the point I was trying to make is this. I gave a speech on the too big to fail problem, and I was basically saying that's a really high priority for regulators. But I just want to make it clear to people in that speech that ending the too big to fail problem is not, sort of sufficient. There's also an issue of behavior and culture that also needs to be remedied. And what I was really trying to suggest in the speech is that, incentives, compensation practices, things of that source, can have consequences for culture and behavior over time. And so we should be also recognizing that this is something, an area where we should be paying some attention.
Yeah, Tomo?
Hi, I'm Tom of GG Press. It's not related to today's presentation. How do you see the virtual currency like Bitcoin? Do you think it would have some effects on real currency or real financial system?
The question is what?
How do you see the virtual currency like Bitcoin?
Well, I mean, I guess just speaking for myself, I think I'm pretty skeptical about Bitcoin as thinking about it as a currency, a replacement currency. First of all, it's not legal tender. I think that's pretty darn significant. I view something like Bitcoin as really more like barter. And then I asked myself the question, why would you want to engage in barter when you can use currencies that are good stores of value, that are stable? So I don't really see to be frank, I don't really see this huge benefit of this supposed innovation. I think the goal of the central bank and of monetary policy is to have a stable currency that retains its value over time. I think we have done a very good job of doing that. So it's not clear to me why we need to see some alternative.
I have a question from Shaheen at the Huffington Post online. His question is, where did Krishna go anyway? No, kidding. His question is for President Dudley. Recent data show that real wages for college degree holders have been falling over the last several years, yet outstanding student debt has risen considerably. Given muted growth forecasts, how concerned are you that student debt risks depressing economic growth? Is there enough available data to quantify this risk?
I think it's something. It's a prospective risk that we want to analyze further. I mean, I think that the fact that the student loan burden has climbed pretty sharply, the fact that it can't be discharged, the fact that real wages aren't rising very quickly. I think it's something that we definitely believe that it deserves further study and analysis. I don't think at this point that I would jump to the conclusion that the student loan burden means that we're not going to have a sustainable economic recovery. I don't believe that, but I think you could certainly make the case that it might be a bit of a headwind and make it more difficult to have a strong economic recovery. But this is why we're looking at this in more detail.
Anybody else want to grab that?
Yeah, this is Jaison Abel. Just to add to that, while it is true that the real wages for college graduates may be leveling off, it's really important to think about the decision to go to school as an investment. So it's an upfront cost, which is paid for in part by student loans, but there is a payoff to it, and really just about any scenario you run at this point still suggests that the payoff is real, that there's a significant benefit from going to college, a four-year college at least. So from that perspective, especially when you consider that the economy is more and more driven by knowledge and really by stocks of college graduates, even though there may be some leveling off, it still seems to be a good investment and good for the economy overall that we've got college graduates.
I agree with that for spades. I mean, building human capital is the best way to improve your economic prospects over time, and college is a really important element, as is employment. I mean, we find that while it's a little harder in this environment for college students to get their first job out of college, and sometimes that first job isn't the job that they would necessarily like. Once they get going and get that experience in place, then we find that they're actually able to get integrated into the workforce, and the gains from going to college turn out to be substantial relative to not going to college.
We started our 30-minute window a little bit early, so we've only got a couple of minutes left. I do have an online question, unless there's one more in the room here. Otherwise, I'll go to this one. Okay, so this is from New Jersey. Oh, wait, yes.
So again, I think basically we need much more research on this. So there are some studies out there, and none of them are really causal. So the studies, they associate for-profit degrees with low income, high unemployment, and higher default rates. But it's important to point out that they're really not causal. So it's very difficult to actually figure out what is the impact of for-profits, really, because for-profits actually educate a very different group of students. As you saw, these are minorities. They're more likely to be minorities. They're more likely to be women. And so it's not like an apples-to-apples comparison when you compare just all for-profits with all publics. So essentially, you need to figure out if the student who is now going to for-profit, where would he otherwise go? It's not clear if he would have just after high school gone directly to work, or he would have gone to a public school or a private school. So just to figure out who is the right person to compare this for-profit student is hard. So that essentially calls for much more research using like what data we have and maybe even better data to try to understand this phenomenon, because this is a very recent phenomenon, and there's a huge, as you saw, like more than 100% growth in the less than 10 years. So like after the recession, there has been 54% growth just between 2008 and 2011 in terms of enrollment. And they seem to have a pretty good impact on the higher education landscape, which we don't really understand right now, which essentially calls for more research on this.
And just to add to that, if you recall, the one thing that was noteworthy about these for-profits is how varied they are. So you have aviation schools, computer schools, beauty schools, and so it's kind of hard to make generalizations because some of these might be a lot more successful than others. It's just a very diverse.
Right, and they actually offer very different niches, right? So the type of education, we might want to get that sort of education rather than a traditional education. So they fill different niches, and they serve different populations. And they're also in different areas. So sometimes because they're in densely populated areas, they might be easier for some people to go to as well.
Okay, and the last question comes to us from New Jersey Online. What are the implications for the regional economy of the fact that, as I understand your statements, the reporter says, much of the job recovery after Sandy is due to jobs involved in helping the recovery? Has that artificially inflated employment rates, and will that dampen the job figures at a later date as the work ends?
I mean, I think that is definitely a good question. I think it really remains to be seen sort of how temporary this is going to be and for how long. It is true that a big part of the rebound did come from jobs that were in the process of rebuilding. I think one important thing that could happen from the rebuilding, though, is that to the extent that what's rebuilt is actually more productive in terms of new infrastructure, et cetera, that could actually raise the overall level of productivity for the region as a whole. It's really yet to be determined exactly what happens along those lines, and so we'll have to just wait and see sort of how long the temporary nature of, say, the construction employment is, and what else happens in the economy to fill that in.
I'll just add to that. Not all of the growth in New Jersey has been, rebound recovery from Sandy. You can identify how much of it is in construction, and there has been good growth in construction employment, but there's also been good growth in other industries. But it's also important to remember that in the construction industry, what you have, it's a very industry of small contractors and small firms, and a lot of how well they're doing is understated by the employment numbers. So if a contractor suddenly gets very busy and hires subcontractors, they're not technically counted as payroll employees. So it's quite plausible that in terms of just the recovery effort from Sandy, that you're not really capturing all of that in the official employment numbers. So to kind of get back to the question, there's probably more growth than it looks like related to Sandy, and it's not captured in the employment numbers. Plus, there's also other sectors other than construction that are contributing to growth there.
Okay, and with that, we'll wrap it up. Thank you to President Dudley and to our panel and to all of you who've been following along online. We'll see you next time. Don't forget to buy a T-shirt on your way out.